If you've ever dabbled in cryptocurrency in Australia, whether by buying, selling, trading, or earning it, you might be surprised to learn that the Australian Taxation Office, ATO, treats crypto as property, not as currency. This means that your crypto activities can have tax consequences. And understanding how to properly file your crypto taxes is essential to staying compliant and avoiding penalties. Let's walk through exactly how to tackle your crypto tax return, demystify what's taxable and what's not, and explore strategies to make the process as smooth as possible. To start, it's crucial to understand that the ATO applies two main types of tax to cryptocurrency: capital gains tax and income tax. Capital gains tax comes into play whenever you dispose of your crypto. This could mean selling your coins for Australian dollars, swapping one crypto for another, or even gifting your crypto to someone else. On the other hand, income tax is relevant when you earn crypto as payment for work, through mining or staking, or by receiving airdrops and referral bonuses. Not every crypto transaction is taxable though. For example, simply buying crypto with Australian dollars, holding it in your wallet, transferring it between your own wallets, receiving it as a gift, or donating it to a registered charity are all non-taxable events under ATO guidelines. Calculating your crypto taxes starts with tracking all your taxable events. For capital gains, you'll need to determine the difference between what you paid for your crypto, including any acquisition fees, and what you received when you disposed of it, minus any selling fees. If you held your crypto for more than 12 months before selling, you're eligible for a 50% discount on the taxable portion of your gain. This can significantly reduce your tax bill. For example, if you made a $10,000 profit on a long-term holding, only $5,000 would be subject to tax. When it comes to income tax, the value of any crypto you earn is assessed at its fair market value at the time you receive it. If you later sell this crypto and it's increased in value, you will also pay capital gains tax on the difference. For those who make multiple crypto purchases over time, the ATO allows investors to use FIFO, first in, first out, LIFO, last in, first out, or HIFO, highest in, first out, accounting methods to calculate gains, as long as you can individually identify your assets. Traders, however, are required to use FIFO. Understanding whether you are classified as an investor or a trader is also key, as this affects how your crypto is taxed. Most people are considered investors, which means they buy and hold crypto with the aim of building wealth over time and can benefit from the 50% capital gains tax discount if they hold assets for more than a year. Traders, by contrast, operate in a more business-like manner, engaging in high-frequency trading, maintaining business records, and aiming for short-term profits. Traders cannot claim the capital gains tax discount, but can deduct a wider range of business-related expenses, such as software, electricity, and even office space. If you're not sure which category you fall into, consider your activity. If you're trading daily with significant capital and business-like documentation, you're likely a trader. Otherwise, you're probably an investor. One of the most important, yet often overlooked aspects of crypto tax compliance is record keeping. The ATO expects you to keep detailed records of every crypto transaction for at least 5 years, including receipts for all buys, sells, and transfers, the dates and nature of each transaction, wallet addresses involved, exchange records, and any costs related to managing your tax affairs. Staying organized is crucial. Exporting your transaction history from exchanges every few months or using crypto tax software can save you countless hours and ensure your records are audit ready. Filing your crypto taxes in Australia is a step-by-step process that begins with collecting all your data, every transaction, transfer, and income event. Once you've gathered your records, you'll need to calculate your total gains, losses, and income, making sure to apply the capital gains tax discount if you're eligible. You then report your net capital gains in Section 18 of your tax return, while any crypto income is declared at Question 2, which covers earnings that aren't salary or wages. You have several options for lodging your tax return. You can file manually via MyGov, use tax software to generate your reports, or send your completed reports to an accountant who can lodge them for you. It's essential to meet the relevant deadlines. October 31st if you're filing yourself, or as late as May 15th if you're using an accountant, provided you register with them by October 31st. Missing deadlines can result in significant penalties, but if you find yourself unable to pay your tax bill immediately, the ATO does offer payment plans for those who are proactive about their situation. There are smart, legal strategies you can use to reduce your crypto tax liability. Offset any capital gains by reporting your crypto losses, and remember that losses can be carried forward to future tax years. Holding your crypto for the long term not only supports your investment goals but also qualifies you for the 50% capital gains tax discount. While investors can deduct the costs of tax software and accountants, traders can deduct a broader range of business expenses. Donating crypto to a registered charity can also provide a valuable deduction based on the fair market value at the time of the donation. Finally, it's important to understand that the ATO is highly proactive when it comes to crypto compliance. All Australian exchanges are required to report customer information, and the ATO uses sophisticated data matching tools to track transactions. If you receive a warning letter, don't panic. Just double check your records and ensure you've reported everything accurately. Ignoring the issue can lead to steep penalties, but addressing it promptly and honestly is always the best approach. If you can't pay your bill in full, reach out to the ATO to arrange a payment plan rather than risking further penalties. To make the entire process even simpler, you can use a dedicated crypto tax software like CoinX. CoinX is designed specifically for Australian investors and supports integration with over 300 exchanges, wallets, and DeFi protocols. Filing your crypto taxes with CoinX is straightforward. First, you import your transactions by connecting your exchanges and wallets via API or CSV files. Next, CoinX automatically categorizes and reconciles your trades, staking rewards, mining income, airdrops, and other taxable events, providing a real-time overview of your portfolio. Once your data is synced, CoinX generates a comprehensive ATO-compliant tax report that includes details of your capital gains, losses, and income, all calculated in Australian dollars. You can preview your portfolio, check for any missing or mismatched transactions using CoinX Smart Error Detection, and then download your final tax report. This report can be used to lodge your tax return yourself or shared directly with your accountant. With its clean interface, auto-labeling features, and robust compliance tracking, CoinX takes the stress and guesswork out of crypto tax filing, letting you focus on your investments rather than paperwork. By following these steps and maintaining good records, you'll be well prepared to file your crypto taxes in Australia efficiently and accurately. Staying informed and proactive not only keeps you compliant, but also helps you make the most of your crypto investments while minimizing your tax burden. Subscribe for more.